All right. Welcome back to the Know Your Numbers REI podcast. I am your host, Chris McCormack, and it is an honor to be with you today. For those of you joining for the first time, so grateful that you would give us your time, that you would invest your time in listening to this. If you get any sort of value out of it, go ahead and subscribe. We're posting weekly podcast episodes about tax strategy, tax news, tax insights for real estate investors and business owners that are just fed up with the amount of money that they give Joe Biden and the US government. For any of you guys or gals who have felt confused maybe, or just concerned, or just looking for a little more confidence in your tax knowledge, okay? The idea is that you're a real estate investor, maybe you're spread across multiple industries, whether that's long-term investing, short-term rentals, fix and flips, wholesaling, private money lending, build to rent, build to sell. Like, there is no shortage of opportunities that you guys are going after. And we know that based on our conversations with you as our clients and with you as our prospects, there's a whole host of information that you try to understand but end up feeling very confused about. And one of those is, how is your income being taxed as a private money lender, as a developer, as a wholesaler, as a long-term investor, right? Those are 4 different industries that I just mentioned that have different aspects to them that cause the income and the deductions that you're able to get to be taxed differently. So this episode will be directed specifically at you, the investor who is spread across multiple industries. Maybe you're even just in another business, or maybe you have a W-2 and you're looking at a couple real estate industries to park your money or to put your money in. Our goal is to give you the information you need to be confident and eliminate that confusion that you've been feeling. And again, if you get any value out of this, go ahead and subscribe. My name is Chris McCormack. I'm a CPA, certified tax planner. I also hold an MBA from Providence College out in Providence, Rhode Island. And here at Better Books, we are focused on you, the real estate investor or the business owner looking to use real estate to pay less in tax. We know that real estate is an industry that is full of tax opportunities, but most investors are not seizing those opportunities, whether it's because of a lack of education, a lack of organization, a lack of proactive planning. There's a lot of things that could go wrong in the real estate industry that could cause you to overpay in tax. And it's our goal to eliminate those things and give you the confidence you need, the returns that you need, and just the overall peace of mind that you need to confidently scale your business, confidently take the foot off the gas wherever you are. So with all that in mind, we can jump to today's topic, which really has to do with the different industries that you find yourself in as a real estate investor. Many of you are familiar with that real estate. Typically, if you go to a real estate conference, or you're surrounded by real estate investors, or you've heard anything about the way real estate is taxed, you're likely going to hear of this idea that it's taxed as passive income. And that is true to a certain degree, but if you are spreading yourself into other industries or other markets, say flipping or private money or wholesaling, you might go in with the incorrect assumption that all of the income you're making is going to be passive, and it's going to be a very rude awakening come tax time. Because while real estate as an investment is taxed as a passive income source, all real estate as an income source does not fall under that category. Things like flipping, as I mentioned, things like wholesaling, things like potentially private money lending or build to rent, construction development, those can and often do fall into the category of active investing, which will open you, the taxpayer, up to ordinary income tax, potentially self-employment tax, potentially payroll tax. All of these things come into consideration when we're talking about a business venture in the real estate space in those industries. So I am going to dive into each of them specifically. This information is going to give you enough information to be confident and understand it more than you did going into this. But at the end of the day, you as the taxpayer have to find somebody that you can confidently say, they're handling my taxes, they know what they're doing, they're helping me pay the lowest amount of tax possible or get the highest refund possible. It's on you as the taxpayer, as the business owner, as the real estate investor to hold that responsibility and to do something with that responsibility. You got to find a tax-friendly CPA, a real estate-friendly CPA who's going to keep more money in your account. So let's start with the first one I've mentioned a couple times since getting started. That is the fix and flips. I start with this one because it's often one of the first ones that people turn to as investors. If maybe you have a long-term rental and you like this idea of real estate, you want to start a business yourself, and you're like, well, I'm already in the real estate space, might as well go into the fix and flip space. We're not really changing much, and we can keep our systems a lot of the same, looking for acquisitions And so you turn to fix and flips and things are going well. You buy your first property and you're deducting all your expenses, and you come to tax time and you are expecting to get depreciation or maybe all the write-offs that you've gathered, but you haven't sold a property. And so by tax law, current tax law, you would not be open to the deductions or depreciation. And that's because the flipping industry is very unique in the way it is handled. So without confusing you anymore, let's just say when you get into fix and flips, you are no longer buying real estate as a long-term investment, as a cash flowing investment asset. You are buying it, you are fixing it up, and then you are selling it. And the IRS classifies that as an ordinary trade or business. And therefore you have to report that as active business income. Just as a CPA firm owner has to record his or her income from tax planning, tax preparation, bookkeeping as active income, the man or woman involved in fix and flips has to categorize their income from the sale of a property as ordinary business income, which is taxed at ordinary rates and not the capital gains rate that you get if you say you hold a property for more than 12 months and go and sell it after renting it out for a while, right? So those are two differences between long-term buy and hold and the fix and flip period. And that is a huge difference that could have massive implications to your tax liability. And one thing that we find often for people that are getting into the real estate space that they are not aware of is, say you buy a property for $100,000 and you go and fix it up for $50,000 additional dollars. So all in right now, you're in for $150,000. You might be paying interest if you got a loan for that initial down payment. Say you hold that property, you buy it in September, you fix it up, you're done, almost done by December, but you still have to put a little more work in, and then you have to get it ready for market, which takes you into the next year. A lot of people, when they're just getting started in the fix and flip space, would be like, okay, I fix it up for $50,000. I'm going to get a deduction of $50,000 on my taxes. And because it's ordinary income, it's also ordinary losses. And so I'll be able to offset that from my W-2 income maybe. And while that would be very hopeful and we would love for that to be the case, it is not the case. Okay. So if you have a fix and flip property and by the time December rolls around, that property is still in your possession, you haven't sold it yet to another party, that property is technically inventory. Just as if you were going to a grocery store and they have all of these snacks and drinks and deli meat and produce and meats and fish. All of that is categorized as inventory on their books and records. And whatever they're holding at year end, just because they paid for it already, does not mean that they get to expense that. They actually have to hold that as inventory on what's known as a balance sheet. And so as the fix and flipper, if you're holding a property at year end and maybe you're short on cash and you put a bunch of money into this property that you're looking to sell here in a few months, but you have a tax bill as a result of the work that you've done from January through December, and you're hoping to decrease that tax bill by the work that you've put into this property, you're going to be in for a very disappointing tax discussion with your tax preparer. So that's another big difference between long-term buy and hold and fix and flips, right? Long-term buy and hold, if you have a property and you're in repairs or maintenance or interest and utilities into that, you can get a deduction in the year that you put that money out, so long as it doesn't have to be capitalized, which is a whole nother discussion. But the idea is that if you have it on your balance sheet, you also can deduct it on the income statement for these long-term buy and hold properties. But the fix and flip industry, if you have it on your balance sheet, you cannot get the deductions on your income statement until you go and sell the property, and then you recognize the revenue and you recognize the expenses as a cost of goods sold, and the profit is now what comes to you, the owner, and it's also what's taxed at ordinary income rates, which again, if you're not careful, could be self-employment taxes, right? So there's a few things that you have to consider as fix and flip investors, as people going outside of the long-term buy and hold strategy, that the person who's just long-term buy and hold, maybe you buy a single family rental, a duplex, you scale up to commercial. Those are big differences between fix and flips and those buy and hold properties that you as the business owner need to be aware of, or at least need to have a CPA who is firmly planted in this industry, because there's a lot to consider when it comes to taxes for fix and flips and buy and holds. And two of them would be, how are you managing the expenses, especially towards the end of the year where you have to carry that on your balance sheet? And then another one would be, what's your entity structure? Because you're going to be on the hook for self-employment taxes if you're not careful. And some of these flips can range in the profit amounts of $200,000, $300,000, $400,000, even $1 million if you're doing some high-end flips. And you're not going to enjoy the tax bill on just self-employment tax. That doesn't include the ordinary income tax that comes with it. And so these are things that you need to be aware of and why we're really presenting you with this information as the real estate investor, because there are massive differences between just the long-term buy and hold. Another one, you don't get depreciation on fix and flips. Okay, so you can come into real estate thinking, yeah, appreciation, it's the best asset class because there's so many tax incentives and tax benefit to being in real estate. And you go into fix and flips, and then you come to find out that you don't even get any form of depreciation. So that's something that you need to be aware of as the real estate investor who's getting started with fix and flips. Okay, another big piece between all of these, so that's fix and flips, there's private money lending, there's wholesaling. A big piece is that ordinary income that I talked about. So typically you have real estate investing for the long term. You're going to be having passive income or passive losses that you can not use against active income, or you can't use your passive losses against the active income unless you're real estate professional status. So another thing is just the type of income and those ordinary tax rates that you're going to be looking at. But let's take a look at private money lending and wholesaling, right? So that's similar to flipping, and then that's an ordinary trader business. It's going to be active income. You're going to have to pay taxes if your entity structure is not set up properly. You're going to be on the hook for a lot of taxes that you weren't paying and that you wish you were aware of. And private money lending, especially, you want to make sure that you're working with a tax professional who is aware of these things, because there's a chance that it could be passive income if you're not materially participating, which is, again, a whole topic in itself. We're going to be doing a few episodes on that and what material participation is and what you should know about it. But if it's not classified as an ordinary trader business, which a lot of people, if you're just doing one deal of private money lending, it's probably not an ordinary trader business. And therefore, you're going to have to be reporting it as interest income. You can't get business deductions typical to the business owner, and you're going to be paying net investment income tax. And what that is basically a 3.8% tax on investment income. So these are things that you should be aware of. Everybody gets very excited, and I get it, man. We get shiny object syndrome as entrepreneurs and people with a go-getter type mentality, and everything looks good to us. We hear about these massive deals that people are doing in the private money space, and then we deploy some capital, and all of a sudden we get it back and we can't take any deductions. We have to pay an additional tax of 3.8%, and it's taxed as ordinary income as well. So these are things that you want to be aware of, and you want to make sure that you're working with the right accountant so that you can confidently say, I'm paying the lowest amount of taxes possible. I know my stuff is getting categorized correctly because I have a relationship with my accountant and he understands what's going on in my business. If I have passive losses and I can somehow manage to incorporate some passive income from one of these income streams, then that's great. I can generate a massive amount of tax savings through that. And these are just some of the things that you need to consider as you're thinking about what is next. Okay, I have long-term buy and holds. Real estate's a great space. I know I want to be here. So what industry should I go into? Should I do the fix and flips? Well, I have to know that I have to categorize things correctly. It's not going to be taxed the same. I'm not going to get all the tax deductions. Should I do wholesaling? Same thing. I need to know that my income is going to be active income. It's going to be taxed as an ordinary trader business. I have to think about entity structure and these things that come up as a business owner. Now I have to think about payroll and employees versus contractors and all these things that just a regular old buy and hold long-term real estate investor doesn't have to. So when you're engaged in these activities and they are a trade or business, it does open up that can of worms that people talk about. And it's so important for you to, one, be knowledgeable about it, know that there's a difference between this and the real estate, because too many investors get into it thinking, well, I can just use my long-term buy and hold to offset my income that I'm generating on my fix and flips or my wholesaling or my private money lending, when if it's not done correctly, you guys are going to be in for a rude awakening. And I want to prevent that by getting you out on top of it, right? We're now halfway through 2024, and it is time for you to be considering the tax implications of these businesses that you're involved in. We've talked about long-term rentals, the passive income, unless you qualify for real estate professional status, right? The big thing there is that a lot of people get into it thinking that there's these big tax deductions and that, okay, I have a W-2 making $400,000. I can offset it because I have depreciation and cost segregation on my rental property. Not true. You need to qualify for real estate professional status to make that passive loss on the long-term buy and hold and active loss to even consider the writing off or the using real estate against your active income and decreasing your tax burden. And then short-term rentals. Short-term rentals are a huge part of this too. And we see a big mistake on short-term rentals when CPAs say they meet with their prospective clients or their clients in January, or maybe if you're lucky in December or November, and they say, hey, oh, you got a short-term rental? Okay, we'll just put that on Schedule C. You'll be good. No sweat. You're all done. When that's not the case, Schedule C is not the place that you always want your short-term rental. And I get it, because real estate is a beast in itself, and there's so much to know about the tax code in real estate. And CPAs are often overworked and just trying to make ends meet sometimes, and pay their employees or make enough to go on vacation with their family. And so they don't have enough time to look into the tax code on these things. And so they hear that you have a short-term rental because they heard at some seminar or maybe just on a YouTube video that short-term rentals can go on Schedule C. When certain requirements are met, they assume that all short-term rentals are on Schedule C. And what happens on Schedule C? You open yourself up to self-employment tax. You pay more in taxes. It's ordinary income. Taxed as ordinary income. So if your CPA is hearing that you do short-term rentals and automatically puts it on Schedule C, you have a problem. And I'm not saying that all short-term rentals don't go on Schedule C. It's either Schedule C or Schedule E. Schedule C is your profit and loss on your personal tax return. Schedule E is the income statement and the part of your personal tax return designated for rental property. So if you have a short-term rental, it could be on Schedule C or it could be on Schedule E, depending on whether substantial services are provided. What is the average stay of everybody there? And so these are things that could impact the way that you are supposed to be accounting for your income and your expenses on your rental property. And add to that the fact that there's a real estate professional loophole when you invest in short-term rentals, and you get this very congested and confusing mix of facts and information, and somebody's got to make sure that it gets on your tax return. And whether it's on there correctly, well, I'm not promising you that your CPA has enough time to determine that, or if they're not meeting with you, they certainly don't have enough insight to determine that. And that's a red flag. That's where you should say, okay, it's time to part ways. Maybe the CPA will be better off because I'm taking my business elsewhere. They can focus more on their other clients, and that's okay. So understand, this podcast is not an end-all be-all to this topic. There's so much information that goes into the accounting and the tax implications of every type of real estate investment, right? Long-term rentals, short-term rentals, fix and flips, private money lending, new construction, wholesaling, mid-term rentals like BRRRR rentals, they're BRRRR flips. There's no shortage of opportunity in the real estate space, and oftentimes it can lead to a lot of confusion, but it doesn't have to be that way. You need to make sure that you're working with a real estate CPA, somebody who's friendly, somebody who knows what they're doing, somebody who can plan ahead. We had one client recently have this exact situation. He had a W-2, was making more than $150,000 in his W-2 single, so he's only getting half the standard deduction that he could be getting if he'd married. And so you can imagine he's paying a large amount of taxes. He also had a long-term rental. And then he was getting into fix and flip space and the private money lending space. And he was just looking for somebody he could trust, somebody who knew what they were doing. And he was concerned because he came to us at the end of 2022. So this was the first year he had his rental. First year he was looking at other markets. First year he's making a substantial amount of money in those terms. And so he was just very concerned about what kind of advice he was going to get and who he was going to get that advice from. And so he came to us. We went through stuff, asked him some questions, got to know him a little bit more, and quickly found out that not only can we get maximum deduction in year one, but as you get into the private money lending space, as you get into the fix and flip space, there are some key that we're going to want to keep track of, and key decisions that we're going to want to make so that you, our client, can pay the lowest amount of tax possible, get everything prepared properly so you're protected from the IRS, and continue to scale your real estate because now you have more money in your account. Year one, we were able to get him a refund of $15,000. Year two, we now have hit generating $22,000 tax-free income throughout his ventures, the W-2, the private money lending, fix and flip, and the real estate rentals, the long-term rentals. He's generating $22,000 of tax-free income. So there are substantial benefits that come, but you want to make sure you're getting it right. And our client is getting it right. He's confident, he's growing, he's scaling, even in this crazy market, which is exciting and it's possible, but you got to get the foundations right. And it's only possible because you're able to confidently say and comfortably say, I can make these decisions because my foundations are there. I have somebody to rely upon. Things are going to change, and we're going to keep having discussions on a regular basis to make sure that T's are crossed, I's are dotted. We're opening every door, closing the ones that don't work, and going through the ones that lead to us having more money and more property. So it's possible, and you can do it too. If that sounds like something that you need, whether it's because you're spread across multiple real estate industries, whether it's because you're just confused about entity structure or how's your income taxed, or I'm just getting started in fix and flips and I want to make sure it's done correctly, or you're worried that December is going to roll around and you haven't sold your properties and now all the deductions that you thought you were getting are not going to be there, fill out the Calendly link. We have a calendar link in the show notes. It's the best way to get a hold of us. You can find some time on there. We'll set you up with a free consult to go through your issues, your challenges, your dreams, your information. And that way we'll be able to tell whether we are the best fit for you, or we can refer you out to somebody else who might be a better fit. We do it every day. We're meeting with investors, and we'd love to have you come join our firm, or at least see if it's something that would work for you. So that will be in the show notes. Again, if you got any sort of value out of this, go ahead and leave us a review, share it with a friend, hit the subscribe button. We're now on YouTube, and we would love to see you follow along there. And leave comments. Tell us if there's any topics that you want to hear about or you think would be valuable to you or your partners. We'd love to consider you guys in the making of these podcasts. But until next time, God bless you and keep moving forward. We'll catch you later.